Welcome, ladies and gentlemen, to Lesson 9, Long-Lived Assets, Tangible and Intangible. Before you go through this lesson, make sure you go through Lessons 2, 3, and 4. They discuss really important topics like how to prepare a journal entry and how to go from a trial balance to financial statements. Those lessons lay the foundation for these lessons right now. So that being said, make sure you go through Lessons 2, 3, and 4. Now let's get on to this lesson. All right. Concepts and definitions. Let's go through those first. Long-lived assets, two types: tangible, intangible. Tangible assets you can touch. There's physical substance. There's either land or a building or a piece of equipment. You can touch it. Those assets are subject to depreciation. Intangible. There's no physical substance. So you can't touch it. These are like copyrights, patents, trademarks, goodwill. All right, those you can't touch. Some of them are subject to depreciation. Some of them are not. Intangible assets with a definite useful life, so you know that that patent's only good for 10 years. Okay, those you amortize. Amortize, what's amortization? It's the same as depreciation, it's just called something different. So you take the cost of that patent, divided by 10, you do that every year, that's your expense, or your amortization expense, same as depreciation. Okay, let's go through some other concepts. Acquisition cost. Acquisition cost includes the purchase price and all expenditures needed to prepare that asset for its intended use. Remember that. That's good. That's a concept to remember. Remember, all these concepts are going to be in your flashcards. All right, impairment. Impairment is the loss. Okay, impairment happens when there's a loss of a significant portion of the asset's fair market value due to casualty, obsolescence, lack of demand. When you know that there's an impairment, like you know that the copyright isn't worth anything anymore because it's expired or you're not using that product, as soon as you know that, you need to write down the value of that copyright. That write down is called an impairment. We're not going to go through an impairment example, but just know the concept. Depreciation calculations. Depreciation calculations require three things: acquisition cost, estimated life, and estimated residual value. We'll go through some examples where we use those, but just know you need those three things to do a depreciation calculation. Remember, book value doesn't equal market value. Okay, well, what's book value? Book value is your historical cost. Remember, we record everything at historical cost, so our property, plant, and equipment is recorded at historical cost. Less our accumulated depreciation. Accumulated depreciation is a contra asset account. Go back to Lesson 2. Lesson 2, you have a chart of accounts, and you'll see on that chart of accounts you have property, plant, and equipment. You also have accumulated depreciation, the contra asset. All right, the net of those two is our book value. Book value does not equal market value. Something to remember. Go on to depreciation definition. Depreciation is a cost allocation process that systematically and rationally matches acquisition costs of operational assets with periods benefited by their use. Okay, go back to Lesson 4. Lesson 4, in our closing entry, an accrual entry, we recorded depreciation expense. It's a deferral entry because we've recorded the cost, we said it's going to benefit in a future period, and now we're going to recognize that expense as we use the benefit. Alright, so we already did that in Lesson 4, but we're just going into more depth about how we calculate that here. Alright, repairs and maintenance. Read this concept and remember it. I'm not going to do any problems related to it, but it's a good concept to remember. Repairs and maintenance costs. Alright, you expense a repair and maintenance cost if ordinary repairs and maintenance does not increase the productivity or useful life of the asset. You capitalize the cost if the repair is extraordinary and it increases the productivity or useful life. What does that mean? Well, just remember the concept. If there's a significant repair that increases the estimated useful life or the productivity of an asset, you capitalize that cost. You put it as part of the property, plant, and equipment. If it doesn't do any of those, you expense it. Doesn't provide any future benefit. Disposable of tangible assets. I'm going to walk through a problem, so we'll get to that one in a second. Alright, now let's move on to depreciation methods. There's three depreciation methods I'm going to go through. These are the three most common: straight line, units of production, and double declining balance. For each of the depreciation calculations we're going to go through, our acquisition cost is the same, and our residual value is the same. The useful life is different because in units of production we use units of production versus a useful life, but we'll get to that. Okay, so each of these boxes are set up the same way. Let me walk you through it. On the right hand side we have book value. To the left of that, accumulated depreciation. Next to that, accumulated depreciation adjustment. That's our current year adjustment. Remember Lesson 4, the entry we booked to record depreciation was debit depreciation expense, credit depreciation, accumulated depreciation. Okay, well that's that current year adjustment is that credit. to the left of that is depreciation expense. That's the debit. That's our expense. All right. So each of these are set up the same way. Then as you go, you say, my book value is decreased as I am booking depreciation expense. All right. So I'll walk through the problem, but just know each of these boxes is set up the same way. All right. Straight line method of depreciation. At the beginning of the year, Round Belly purchased a new fishing trawler for $80,000 cash. The boat has an estimated useful life of 3 years and an estimated residual value of 20 grand. Okay, so how do we calculate our depreciation expense? Up above on the straight line method, you see depreciation expense equals cost less residual value divided by useful life. All right, so our annual expense is then going to be, okay, our cost, 80 grand, less the residual value, 20 grand, so that's 60 grand, divided by the useful life, 3 years, 60 divided by 3, that's 20 grand each year. Go through the boxes. Each year we have a depreciation expense, 20 grand, a depreciation, accumulated depreciation adjustment of 20 grand. Our running accumulated depreciation balance, first year is 20, second year is 40, third year is 60. Our book value is reduced each year by that running balance. So we start at 80, go down to 60, go down to 40, end at 20 because 40 is our residual value. That's the straight line method. Let's go double declining balance method. All right, double declining balance method. In the pink box above the information set, you have the formula. So similar givens. At the beginning of the year, Round Belly purchased new fishing trawler for 80 grand. The boat has an estimated useful life of 3 years and an estimated residual value of 20 grand. Okay, so how do we do the calculation? Double declining balance. Depreciation expense equals net book value. So net book value. What's net book value? Our cost less our accumulated depreciation. Net book value times 2 over the useful life. All right, this is just algebra, simple calculation. We just need to get the plugins. All right, for year 1, depreciation expense equals net book value. What's our net book value at year 1? It's the 80 grand. We haven't recorded any depreciation. 80 times 2 over useful life is 3. What's that? That equation equals 53,333. That's our first year expense. That's the adjustment to accumulated depreciation. Remember, debit expense, credit accumulated depreciation. Our net book value is 80 grand less our accumulated depreciation, 26 grand, 26,667. All right, that's our book value. All right, year 2, our depreciation expense is depreciation expense equals net book value times 2 over useful life. All right, our net